have a toolbar. I don't have a video option on the bottom.
Well, I don't know. We'll figure that. We'll fix it next time, and they're just gonna have to see your picture.
Okay, well, that's actually easier in case my cat walks through and sits on the screen.
All right, why don't we go ahead and start? Others can join. Of course, we are recording this, so it'll be on demand later for all the registrants that weren't able to make it. I'm Paul Siegert with PCS Advisors. I'm the managing partner at PCS Advisors. My background quickly, I was a Russian intelligence analyst, worked for the NSA, so I'm a nerd officially, love numbers. And I somehow ended up in working for an insurance company. And I saw in that experience, in that part of my career, that we had a really great business model where we could give employers an increase in premium every year, not tell them exactly why, and there wasn't a whole lot they could do about it. And that got frustrating. And so I went on a search to find ways to get better results for employers, became a consultant along the way, met Gary, and was very impressed with his knowledge around the role of a CFO. And he took an approach to it that was different than others that I had the chance to meet, and is able to get measurably better results in many different areas of a business. And so we had quite a few conversations over the last few years and decided to put a group together where Gary could share some of these things. And so that's really our goal. And on our next webinar, we're going to do these monthly, and the next time we'll make sure Gary's camera's on. But for now, you all can see me, and I'm going to run the deck for Gary and turn it over to Gary to introduce himself and take us through our first meeting together. But thanks for being here.
Thank you, Paul.
Gary.
You hear me okay, Paul?
Yep.
Okay, let's roll the slides here, Paul. So first of all, good afternoon to you on the East Coast and good morning to you on the West Coast. I am Gary Bender, and for some reason my camera's not working, but my mic on my camera is working. So I want to introduce, and I want to thank Paul, first of all, for getting this group of his clients and CFO prospects in his network together. I want to review what we're going to talk about. And just to let you know, we're not going to talk about healthcare today. We're going to talk about the best practices in the CFO Solution organization, and we're going to explain how this works. And then after about 25 minutes of introductions, we're going to talk about the best findings on how to run the finance department like a profit center. So if you can roll to slide 3, Paul, we'll just keep rolling here. And by the way, if you have questions, just blurt them out, and we'll deal with them then. Okay, CFO Solution. We started this about 7 or 8 years ago to just share best practices among fellow CFOs. And very simply, we've written down best practices from hundreds of CFO peers, and we put them in a website called the CFO
Go ahead, Jack. We should be able to hear you. Okay. Looks like I lost Gary's audio. What the heck happened?
it's power. Hang on a second.
Okay, all right.
Generator just kicked in. I'll bring it up soon.
Okay, I'll let everybody know. No problem. All right. Okay, folks, we had a little power issue on Gary's end, but he's getting logged back in. So thanks for your patience. Jack, I'm going to assume that was why your hand was raised, but I think you're unmuted and you can talk if you'd like to.
Am I on Zoom now, Paul?
Okay, I don't see you yet.
No, I'm just saying, I didn't know if I was hooked into the website, into the Zoom platform.
Okay. Gary is logging back in now, everybody. Thanks for your patience.
Paul, was there a question? Am I on Zoom?
I've got you on the phone here, Gary. I'm just waiting to see you show up in the list of attendees so I can make sure you can talk.
Yeah. Just tried to flash there. See here. Oh, I got a laptop phone.
Thanks everyone for hanging in there with us. If we can't sort this technical issue out in the next couple of minutes, we'll reschedule this, and I apologize if we have to do that. But we're working through it with Gary here to see if I can't get him back on.
Can you hear me? I don't understand it. I'm on.
All right, we'll just stay on the phone here.
Okay.
Okay, is everybody, let me know if you all can hear Gary. Gary, go ahead.
Okay. Well, folks, I have no idea what happened at my end, but we'll start all over again. I'm pulling up my deck so we can fly remotely. The co-pilot and the pilot are 2,000 miles apart here, folks. So let's go to slide 3, Paul.
Okay, I'm going back into the slide deck here.
Okay, slide number 3.
All right, let me hit go on this presentation. Okay, thanks everybody. We are on slide that says what we do and how.
Okay, what we do and how. Okay, we started a group of peer CFOs to document and share best practices 6 or 7 years ago. We're helping each other become stronger. Our controllers to CFOs, CFOs become stronger, and some become CFO pluses. We share what we've learned. Next slide, Paul. I'm going to go quickly to get us back on topic here.
Yep.
You're on slide.
What we don't
Okay.
do. Yeah.
What we don't do, we're not a consulting firm, folks. We're peer CFOs. We're not selling you anything. We don't try to embarrass you. We try to help each other. I can tell you, I learned from every interaction with our topics and our speakers. Next slide.
Yeah, go ahead. I'll stay up with you.
Okay, we started this back in 2008. I started it because I was a CFO in deep water. I didn't know where the rocks were. We created a group in 2014. We started writing stuff down, and with Paul's help, we've expanded to a national CFO forum group. Go ahead, Paul.
Go ahead.
Okay. For example, we've helped all of each other. And by the way, there's about 300 CFOs in the group right now on the East Coast. We've delivered some hard savings. You can see there on the slide. We've reduced healthcare 30–40%. We've helped people get tax credits, training credits, IC disc, cost segregation, tax reductions. Just this year, we've recently helped a large handful of companies get about $8 million tax credits and reduce healthcare and learn how to hire people. We have sessions every month to deal with that. And we're actually helping CFOs in search, which is helpful. Occasionally, if you've connected to me through LinkedIn or through our website name is the CFOsolution.org. You can, the whole purpose of today is to do executive overviews of sessions we've spent an hour or two on. In fact, we're up to 70 sessions now, so you can see 70 sessions of content, which are typically an hour hour to an hour and a half of Zoom discussion among peers, led by a subject matter expert partner panel, and then backed up with the slide deck. And sometimes there's a case example or a testimonial. The way we're going to do the virtual session, it's always going to be on the third Wednesday, 2 o'clock East Coast time. And we'll get it through Zoom in an efficient way. And we will, our next session's in December. We always cover 2 sessions in each session. Our next session will be on cost reduction and tax credits, 30 minutes on each, followed by the human capital side of recruiting, hiring, and training, followed by on how to better manage facility costs that you're probably responsible for one way or another. And then in February, we'll cover Paul's favorite topic on healthcare best practices and how to dramatically reduce your healthcare costs. Next slide, Paul.
Got it.
Okay. Let's talk about, and I tried to get us back on topic there in a hurry. Any questions from the group? And I do apologize for our disjuncture, if that's the correct word. Any questions or anything in the chat room, Paul, since I can't see it?
Yeah, if there are questions, please go ahead and type them into the chat. We don't have any right now, Gary, so you can keep on running.
Okay. Let me take a breath for 1 second, because I found the source of my power problem. Okay, so let's talk about running finance in a different kind of way. What I title it is how to run finance like a profit center. And let's just think about it. We're an overhead department. We typically have $1 million or $2 million overhead departments when you look at salaries, benefits, occupancy costs, banking fees, audit fees, technology fees. And my guess is that in your company, if you get a $2 to $5 million overhead department, like sales, administration, or contracts, or even the sales department, right about this time of year, you would be going through a budgeting session where you beat up the head of those departments to run faster, better, cheaper, and show year-on-year productivity. My question is, as we start this discussion, is do you look at yourself the same way? Do you look at finance the same way you look at every other department? And I'm coming back to the title of our session, how to run finance like a profit center. Do you know how to drive cost reductions within finance? Do you know how to drive cost reductions and process improvements across your entire company? And by the way, whether you're a CFO, a nonprofit, or an academic institution, or a hospital, or a good old-fashioned for-profit business, this is what we're talking about today applies. So there's a couple ways to do this, and we're going to talk about each of them very quickly here. For example, do you have a process to close the books and issue useful reports? So two important questions here. Do you have process within finance and accounting, and you use it to actually be a better supplier to your customers? Most CFOs and controllers don't think of themselves as having customers other than the bank and maybe the board of directors. And we're going to talk about how to lower the costs in finance, and then, oh, by the way, how to lower the costs in every other function in your company. Next slide, please, Paul. Okay. As I've alluded to, during the budget process, did you actually present your own department to your peers and do your own spending analysis? Did you set a goal for both 2021 and react to how you did this year? Did you set a goal for 22? Have you done a hardcore productivity analysis? Have you presented and reviewed the capital expenditure plan? Have you reviewed the training plan? These are all questions most of us don't do because we run the budget process, we run the reporting process, so we don't want to throw ourselves in that spotlight. A lot of us are more comfortable being the cost cop to pick on other departments. And frankly, I don't like acting that way. So let's come back to focusing on finance. We all have requirements, whether it's the mundane items of doing payroll and invoicing and collections, and doing other mundane tasks, be it weekly or monthly reporting to the bank, making quarterly tax payments. So those are the basic requirements we have to do. And again, do you have a way of looking at your performance and payroll accuracy, the cost of payroll, invoicing accuracy, collections accuracy, and how many credit memos you create, how many write-offs you have? Those are all hidden costs of finance. Again, all of us know this. Everybody in the call understands what finance has to do. I'm focusing today on, have you looked at a better way to do it? And a better way for two reasons. As the way I say here, we deal in two parameters, time and money. Let's analyze both. Let's go to the next slide, please, Paul. Yeah. Before we even get to that time and money question, everybody in this call understands we better have controls in place. We better have procedures in place. And that's where a lot of people stop. Unfortunately, is where we have decent controls in place. We have decent procedures in place. And hopefully our cost accountants, clerical people, and analysts and accounting managers are following those procedures, because as CFOs, we assume they are. And hopefully we don't get surprised at year end or a quarter close or year end by an auditor. Most of us don't have closing process documents. So it's awfully hard to measure something across in a process manner if you don't have it documented and you don't measure it. As you recall, when I introduced this whole topic, is we share best practices and best processes. In my mind, best practices start with getting your actions, your activities within your own silo working before you even start talking about reporting. And if your invoices are correct, and they help sales sell better and not embarrass the company on collections. In the best case, you have best practices documented. Then in a world-class company, you have processes documented that thread across all functions. So they look at the creation of data, the source of information, and create information that can be useful sooner as opposed to later. So what I'm talking about here is integrated processes with your data suppliers, which could be the shipping department, could be your operating department putting information into a payroll system, could be your employees swiping and scanning information into the department, et cetera, et cetera. And then the flip side is we all have customers, and from a finance standpoint, our customers are the people that get our reports and use that information. Next slide, please, Paul. So I'll summarize a bit of what I just said there. We assume our controls are in place. We don't like surprises when we find out they're not being used. But let's face it, we're all dealing with turnover. We're dealing with people working from home. It's not the same when you don't see your staff. And especially if you have new staff turnover. Frankly, we find it, documentation is pretty old, ignored, people are busy. And it comes back to, if a shipment of a bad product goes out, we pick on quality, we pick on operations. When we issue a bad report, pay the wrong vendor, pay the wrong amount, bill the wrong amount, we aren't as critical on ourselves as we're very good at being critics of others, okay, and myself included, but we have to be critical of our own processes and our own performance. So many of us don't know what our client needs are. We just issue the same standard accounting reports every month, sometimes every week, sometimes every quarter. So I'll start with the question, how often do you actually sit down and talk to your customers and ask them, are our standard reports useful? or do you have to throw our information out and run by the seat of your pants? And what would you like instead? And just ask them a very simple question. If you had to buy this report, if you had to pay me for my services, what would you pay me, or would you fire me? And that's a tough conversation to have, but I insist the only person that can have that conversation is the CFO with the other senior execs of the company. Let's go to the next slide, please, Paul. Let's think about all the costs that comprise our $1 million, $2 million, $3 million budget for finance. So labor is probably 60, 70%. And these are FTEs. These are people, might be outsourced, might be third parties that do all of the tasks down the left side of that slide. We got the famed other category that exists, and leadership is you and me that is in charge of finance. We then have hard costs, again, pretty obvious if you're looking at your budget and of everything from space, bank fees, your audit fees, your any consultants you use, any temps you bring in, and training costs, and again, whatever else hits in the famed other category. So that's what makes up, I'm using this example of a $2 million cost stack. Let's take that concept and now ask yourself, we have 20 work days every month. Ask yourself when your process starts. And I'm going off slide here for a second if you're trying to follow that. Think about when your closing process starts. It might start on day -3, it might start on day 2 or 3, where you start to gather information. The typical process is you gather information, people start looking at payroll entries, and they put them into the system, and they find out there's a discrepancy. So all of a sudden on day 3 or day 4, a cost accountant is trying to figure out why the overtime number doesn't make any sense, or why the FICA doesn't make any sense, or why one department isn't in the system. So all of a sudden, work that could have been checked every week on every payroll system run. Instead, a lot of companies rely on a month-end payroll fee, manipulated with allocations. Take a look at it, and they find out on day 3 or day 4, they had a problem 3 or 4 weeks ago with the payroll processing. People got paid, but the cost detail wasn't in the general ledger, or it wasn't incorrectly. So all of a sudden, you're 3 or 4 days behind in the close cycle. Work that could have been done day -15, day -10, day -5, so you don't have problems in the payroll system 2, 3, 4 weeks earlier. And you don't have to look like idiots running around trying to figure out what happened in the first or second week of the month. Now, I'm sure everybody on this call is going to say that never happened to me, and I'll bet you lunch somewhere in Philadelphia that it's happened to you. And the reality is, there's probably times as a CFO you didn't know something didn't work in your closing because some cost accountant or a supervisor of accounting ran in your office and say, we don't understand why this worked, but we'll get it fixed in a day or 2. It's just a delay in closing. This happens, again, I'm preaching to the choir. This happens in every company, whether it's accrual reversals, whether it's an invoice that had an extra digit in it, it's either a $1 million invoice or a $10 invoice, that when you looked at your billing runs, didn't make sense. You know you billed that guy $100,000. Where's it at? And you have other ways to check, what revenue should be. But all of a sudden, you're doing a variance chase on this 3rd, 4th workday when the books should be closed and reports should be generated. You don't have a process. Now, go back a slide. Don't move the slides, Paul, when I say this. What I'm saying is, you've got a $2 million budget, in my example. That's $150,000 a month. Ask yourself what everybody does on workday 1, 2, 3, 4, 5. Build yourself a bar chart or a calendar chart. Just say, what are people doing on day 1, day 2, day 3? And why can't we close in 5 days instead of 12 days? Why would I do that? Well, if I get information to my analysts or to me as the CFO 5 days earlier, I can go from being a data gatherer, data checker, data inputter to an analyst and a reporter, and now a management analyst where I can sit down with managers and say, what are we dealing with here? What's happened? And how do we improve this? That's our job. It shouldn't be at the 12th or 13th workday. And it should be. So number one is what takes 12 work days ought to take 5. If you have a process and if you have your quality checks ongoing throughout the month as various reports are being generated, billing reports, payroll reports, you're billing every day or every week. You're doing payroll every week. That information should be valid, should be correct. There is no excuse in the world why that takes so long to get done. But I would contend that a lot of companies that happens. So you can't start to run finance like a profit center if you don't have a process to be efficient, just gathering data, inputting data, and generating fundamental reports. First point is create the process. You eliminate a lot of tasks, you improve your quality, oh, by the way, and then finally, you can ask yourself, rather than add people in 2022, can I either redeploy people or can I let somebody resign, retire, or deploy them elsewhere in the company to eliminate tasks, eliminate their costs? Because your choice is, if you can't do that, somebody's going to tell you, hey, you've got to cut your costs. And I don't care how you do it. They're going to freeze wages, fire people, or figure out a way to cut $100,000 out of that $2 million budget. Most of us are used to having an inflationary plus spend growth every year. So 2 million becomes 2.1, becomes 2.2, 2.3. Again, if you start with a zero-based budget, if you look at your closing process, you can take costs out just by getting more efficient and perhaps reduce FTEs. I'm not a bad guy in the fact that I like to fire accountants or clerical people. I'd rather redeploy them, and if somebody chooses to leave, not have to replace them and have enough process documentation that those tasks can be absorbed or automated. Let's look at another cost. Again, I've talked about a $2 million cost, hard costs and soft costs of finance. I haven't buried in that the cost of write-offs of incorrect invoices or bad credit decisions, or the interest cost by carrying receivables 30 or 60 days longer than you need to. But if we all are honest with ourselves and reflect on it, the true cost of finance includes interest costs and any write-offs, because a write-off is a failure of both sales and credit and collection. And a write-off that's 120 or 200 or 300 days old is a terrible failure. Oh, what's the next slide?
Value options.
Okay. Any questions coming through the chat?
We did have a question about whether or not the slides would be available after. My answer was yes, and we're also going to be making these recorded sessions available on demand.
And in fact, they'll be available on the CFOsolution.org website. So
we'll get an email out to everybody that attended and those that registered that weren't able to attend with links to guide you to the right places to find all the information we're going to need.
That's great. Okay, so I've had I'm now flying blind here, Paul, so I'm working off memory. What's our next slide?
So value options talks about reducing operating costs of finance, reduce labor.
No, next slide. Next slide.
Yep. Okay. So our next slide is not so obvious items. Examining HR spend, cost of turnover, WOTC.
Okay, thank you. So I talked a minute ago about you've got your hard costs in the finance department. Again, I'm using my $2 million a year example. I then talked about soft costs that are pretty directly related to finance, and that's interest costs for slow receivables, the write-offs of either an incorrect invoice or an invoice, billing for something that was defective. It should have never been shipped. But at the end of the day, you wind up with a write-off that reflects on finance. and the whole process. You then start getting into how can we help other organizations? And the popular topic today, it's either supply chain or we don't have enough employees. So now you start to say, and here's a question for all of us. Do you know the following costs? Can you enumerate and explain at a management meeting or a one-on-one session? Do you know what supply chain delays are costing the company? Are we running overtime to make up for late shipments? Are we missing shipments, incurring penalties? In other words, the operations department, procurement may not understand the real impact of supply chain problems. Everybody complains about it, all the ships out in Long Beach, but nobody's doing anything about it. And more importantly, in my mind, nobody knows the cost of supply chain problems. Same thing with employees. If we're 5 employees short on the factory floor, certain things don't get done today, this week. But again, have you ever sat down with HR and operations and said, if we had those 5 employees, what would that do to our costs? Obviously, wages go up, but overtime goes down. Obviously, training costs go down if you're not training employees. Now you get to the subtle things. What are we spending on advertising and recruiting fees? So all of a sudden you sit back and say, what's the total cost of turnover? You have a $50 million company with $20 billion of labor costs, just strict labor and benefit costs. And if you have a 5% turnover versus a 10% turnover, it's probably $1 million. So you look at all the costs. But I contend that most of us are too busy trying to close the books and get reports out the door to the bank and to the management team to have those useful reports generated. And I'm not sure if people are agreeing with me or assuming that this doesn't happen in your company. But again, I would ask, do you know the cost of your human capital turnover and training? You can probably tell me we spent $212,000 of training last year. Can you tell me if there's any return on investment? I would ask, did you spend, I'm kind of making up numbers for all of us, if you wrote checks for $212,000 to trainers or courses or seminars, did you include the cost of all the man hours you traveled to get to that training? You're going to find out in a hurry, you're spending $750,000 a year on training. When you think about time out away from the office, away from the assembly line, travel to get to a session, bringing people in, etc. Again, I contend a CFO who is adding value to the organization looks at things that way. Same thing with, and let's just keep talking about it on training. There's a variety of ways to find money to help HR. So if you came back and talked to HR that said our turnover went from 5% to 10%, I'm not here to listen to excuses. I'm trying to figure out what does that really cost us and where can we use that money. It might be a wage increase. It might be better benefits. It might be a recruiting process that has 80% hiring efficiency versus the 50%, but we're hiring the wrong people. It might be insourcing or outsourcing labor. Most HR people, and I will criticize myself as well as I'll criticize HR managers. I'm not trained in HR, but in half of my CFO roles, I've been responsible for HR. It was a challenge for me to look at HR through the lens of a CFO and realize they've never been getting the information. They don't even know what our turnover is, other than they've got 8 requisitions to fill and overtime's high. If we don't give them the information, going back to what I said about useful reports on day 8 or day 9, instead of a standard report that's useless to HR. So if they don't know the cost, shame on us. If they don't know how to do the analysis, shame on us. We should be out working with our customers any time of the month, but especially when the monthly reports come over versus a goal versus a standard on what does it mean to have 8 open recs and 12 people missing in the factory? We need to spend more dollars on recruiter. We need to spend more on Indeed or ZipRecruiter and explain to the CEO with the HR person sitting there with you, we're increasing our spend because our turnover costs are eating our lunch in both a hard cost standpoint and a soft cost performance to our customers. Again, partner with the client, HR in this case, and say, here are the real costs. Now, how can I find training funds for you? There's a lot of state and federal training funds available. HR people generally don't know they're out there. A lot of CFOs don't know they're out there. A lot of people don't know there's credits such as the WOTC credit, Work Opportunity Tax Credit, for most of your new hires. They average $300, they go up to $9,000 if you hire a veteran. HR doesn't know how to do that, and they're so busy getting yelled at to reduce overtime and find bodies to interview that they need a partner in finance. It starts with the right reports, time to sit down with HR and to partner with them rather than just report all this overtime's killing our budget. Not sure if people agree with me. I'd love to hear comments. But the first step I'm suggesting, and I'm using HR as an example, but it's one of many, is do the cost analysis, help them understand it, and then look at ways to reduce that cost. Second part is let's stand back in the common day, when you're not getting ready for a management meeting to explain why labor's screwed up, overtime's too high, and we can't find people to hire, is sit back and look at, do they have a process? Ask your plant manager, ask HR to sit in. Are you getting the right candidates? Is the job description good? Do we have glass door feedback? Do we have exit interview feedback? Because something's not right. If we've gone from 5% to 10% turnover, let's understand why. Let's do the root cause analysis. And I contend that the CFOs on this call are much better prepared to do the objective root cause, process improvement, financial analysis, action analysis as partners to those functions. Let the CEO know you're working with them to address the issues, not just continue to report bad news and budget variances. The outcome of that is you might just start hiring better people. You might have lower unemployment claims. You will have lower recruiting costs and advertising costs, and a lot of other hidden soft costs. Let's go to another example. I talked about analyzing HR costs, turnover costs from probably the epitome of the softest costs that we can analyze these days. Let's talk about what if we could lower risk? So again, I contend the CFO is at the intersection of resources, risk, and rewards for the company. So you might have a risk manager, you might outsource risk to your insurance advisor. At the end of the day, I contend a good CFO owns risk. So they analyze risk and they look at ways to reduce risk, because when you reduce risk, good things happen. Lower cost, fewer injuries, fewer delays, fewer lost shipments. How would you do that? For example, again, I don't have all the answers. This is what came up through all our peer discussions. Understand your workers' comp claims. Workers' comp means somebody got hurt, seriously hurt, or killed on the job. And that drives, obviously, an increase in your claims. Less obvious is your premium goes up for the next few years. Worst case, you go into the drunk driver pool for factory accidents, and you have a really hard time getting insurance. And it could affect the way certain customers look at your reputation and if they want to do business with you. Again, understand the risks. You can identify the hard cost impact very quickly, but there's soft costs. Loss, again, you've got employees that are being injured and on rehab, and you know what? They're usually not very happy that they got hurt on the job. And they're usually not rehabbing very hard because they get paid just as much to sit at home and make sure they're 110% shape, and all the honeydew chores are done around the house before they come back to work. Again, your business broker, your work comp advisor may try to help you in getting them back to work earlier. The bigger question is, why did the accident happen? Do we have the right training? Do we have the right guards in place? Is the lighting correct? All those simple things, we can ask 20 questions in an organized manner and see if we have a process to train people, process to review our safety independently, certainly a process to investigate any accident. Most of you are going to tell me that's not my job. We have a safety environmental manager. You know what? They're not financial analysts. They're not sensitive to the cost of insurance. They're not sensitive to having a person off the assembly line costs us overtime or delays our shipments. They're not trained the way we're trained. Next example, I kind of beat that horse, sorry about that. Next example, unemployment claims. If you hire people, keep them on the payroll for 60, 70 days, I'll use the Pennsylvania example. After 60 days, you lay them off, you own them for 26 weeks on unemployment. If you get rid of them after 15, 30, 45 days, you know, again, if the employee is absent 5 times in the first 15 days, his behavior is probably, or her behavior is probably not going to change. If on-time attendance is important, and ultimately it's going to lead to that employee being fired, fire them early. Keeping a bad employee around just causes you problems, hard to solve cost problems, but it also leads to an eventual unemployment claim or termination or severance. Again, is there a process to analyze how many people we hired last year, how many were here after 30, 60, 90 days, how many were here after 180 days? Were they promotable, or did we make a bad hire? There's no reason to have a bad hire at 90 days. Generally, bad behavior shows up very quickly. Just have a process to review 15, 30 days. If you've got a yellow or a red score on that person after 30 days, again, finance needs to force the process to have a review of new hires and have action items put in place, act like the cost cop, the process cop, and force the decision the 50th day. In our company, we never have terminations after 59 days. By the way, I am a full-time CFO of an engineering company, so I'm not a consultant or a trainer or an unemployment claims expert. I can just tell you we went through a lot of this. Again, technically, these aren't your job. I contend they're the job of the CFO. Let's go to the next slide, please, Paul. So if the examples that we just talked about were outside your job, these are really outside your job. But I contend that if your job is to add value, reduce risk, reduce costs, and help the CFO and the CEO run the business, let's redefine your job. Do you understand the cost of leasing or owning your facility? Are you doing everything possible to reduce the cost of owning that facility? I'll give you one best practice example we'll talk about in a couple months. If you have a 5-year lease on your office or warehouse, and you're waiting until 90 days before renewal to either negotiate renewal or consider downsizing or going to a larger space, you have lost the battle. If you're not a year ahead of your renewal to understand what do I want to do with this property, if your landlord owns you. At 90 days, the landlord owns you. Okay? We've actually gone through, and we'll touch on it in a month or so or two. We'll touch on if you're really a good CFO, you manage real estate strategically. You think about where you want to be for the next 5 or 10 years. If this is the factory site that is perfect for your company, should you buy it? Should you go into 10-year leases with 5-year renewal options automatically? Because the irony is it'll give you some stability, plan for improvements, security improvements, automation, spending. But more importantly, if you go to a landlord with a 10-year lease versus a 3-year or 2-year renewal, you can negotiate lower lease costs than you have today. If you can show them you've got a 10-year lease commitment and you're willing to improve the site and work with them, and you're going to be the greatest tenant, you only have to talk to every 5 or 10 years, you can negotiate a lower lease rate. And we're actually going to show you, or you can go to our website and see it. You can actually see the financial analysis of how much that is worth to a property owner if they have a 10-year lease versus a 3-year lease. Jump past, and by the way, same thing for utility, building insurance, business interruption insurance. Finance has to be involved in taking an active role in that, working with operations and the CEO. Shipping costs, they're through the roof, especially if you're doing anything in China. Are you involved, or do you expect procurement to be financial experts on negotiating and understanding all the analysis, all the hidden costs, and the risk in your terms of your shipping to customers, or you're receiving product from suppliers? If you're not on top of that financial analysis and risk analysis, I contend you're not doing your job as a CFO. Remember, I've been in your shoes. I'm in your shoes today. If I spend 12 days a month closing the books, I don't have time to do this stuff. That's why I started this whole premise with reduce closing from 12 days to 5 days, free up 7 days for your organization, automate it, make people's jobs more meaningful, more automated, less crap work and cleaning up errors that somebody else made 2-3 weeks earlier, and turn those people into maybe a cost analyst. Maybe they're your shipping accountant person who can gather data and help your analyst or help you do the shipping analysis, or if nothing else, get procurement the kind of information they need on what their shipping costs are doing and help them budget, help them analyze. A quick pass on how to reduce costs. A lot of us don't like the phone calls we get from, I can save you money if you give me 50% of it. We always get those calls on telephone, telecom, utility bills. Sometimes these guys are really good. Sometimes they really have expertise that your procurement department is never going to dig into the cost of your telephone, telecom, cell phone system. 30 to 50% reductions are common. I hate writing contingency checks to contingency partners, but if they're saving me $5 or $5,000 a month and they want $2,000 of it, I'll write that check for a year or two. But again, procurement's not going to dig into that as long as their costs aren't out of control. If they're only going up 5% per year, they're going to accept that and renew the contract or sign the purchase order. They're not going to bring it to anybody's attention because it's only $10,000 a month for phones, and it's been $9,000 or $9,500. Look at the cost of computing. Look at the cost of other services they should be dropping instead of increasing with inflation. Procurement doesn't have that mindset on the non-strategic purchases. These are just pain in the butt POs. Frequently your plant manager, terminal manager, sales administrative clerk is signing these POs. They never get to procurement. They never get to your desk. Next topic, just understand your contract terms. Do procurement and sales understand the terms and the impact of what's buried in either the purchase order they're signing or the sales agreement or the sales proposal they're signing? Again, their job is to get supplies in at a reasonable cost, no surprises, no delays, and sales is to sign more business. If they're sliding out the 60-day payment terms, if they're sliding out to the supplier, if we pay the shipping terms and we have all the risk, all of a sudden we've got insurance risk, more insurance costs. They don't know the insurance costs went up 10% because they agreed to take the risk on delivery. They just thought they buried it in the freight cost. But the risk is a real cost eventually. Next slide, please, Paul.
Yeah, I'm on measure and report, and I just want to give you kind of a, not stone, but a little bit of a 5-minute warning. I'm thinking if we end up doing the second topic up next time, just because of some of our tech issues, that's probably okay.
Okay, great. Thank you.
We got about a 5-minute window here.
So let's come back to, hey, all the CFOs on this call, we're pretty analytical. We understand costs. So if I want to reduce the cost of finance, okay, what would I use for my goal? Well, the people in this phone are the most expensive part of the organization per head. The goal I always said is whatever my cost is, I want to save 3 times the cost of my salary, benefits, comp a year. So if I make X, my goal, and the goal in my head, okay, was to save 3 times whatever it cost me. Because I'm kind of under the premise, this department can run without me. If we're running okay now, it can kind of run okay without me watching the process. So if I want to drive process improvement, let me save, $100,000, $200,000, $300,000 a year is my goal. So rather than a 2.5%
a $2 million budget, I really think I ought to spend $1.7 million or $1.8 million. If you're really gutsy, tell the CEO you expect to be flat for this year and next year because you're putting in process improvements. And oh, by the way, I want to save another 1 or 2 times my cost by helping procurement, shipping, sales, etc. It's gutsy to do it. For anybody on this call that's thinking about changing jobs, or you're in search because of whatever happened, a great way to impress a CEO is to talk about, I know how to not only reduce the cost of finance through efficiency, but I can reduce the cost of safety and shipping and procurement, and by using best practices proven other companies, that is what I can bring to the company. So whether it's safety, day sales outstanding, whatever it is, think about all the information we touch and how you can share them. I talked about this before. Next step is do the analysis. The home run ball is process improvements. Process improvements in finance, process improvements in your organization are permanent. Even with turnover, even if you leave the company, a well-run process should continue across personnel changes or organizational changes. And process change will drive significant change. If you've studied process changes at all, 1 standard deviation, which is a lot, it's very, very common. That's like a 12% reduction in time, which means 12% reduction in output, and 12% reduction in cost by process change. And a lot of them are more significant than 1 standard deviation. Next slide. If you're having a hard time getting your hand around this, put a calendar out there. Just ask everybody during closing. Keep track of what you do during closing. And I'm asking because I want to know where you're having problems getting inputs, getting good data, having the system up and running, having IT available. Just let everybody, ask everybody to document what they do during close as how can we make your job better? Not how can we eliminate you, but what's causing you frustration? What's wasting your time? What's giving you data that I call false precision that a day or 2 later you have to rework? Just find out what your employees tell you. Get involved in the close process. You can do the same during the budget process, the same during whatever other processes you do. Listen to what's bothering your employees. Next slide, please. Yeah, there. Like I said, start small. You're not going to fix the world overnight. You're not going to fix the company until you fix finance and learn how to do process improvement. And start finance first. Start to help HR, start to help shipping, start to help operations. Document it, celebrate them, give them all the credit. Don't go after the sacred cows. Don't go after the country club expense or travel and entertainment by the sales department. It feels personal. Don't go after that one is my advice. Next slide. I think I'm going a mile a minute here. In December, we're going to talk about cost reduction. We're going to spend half an hour on cost reduction. We're going to spend half an hour on how to reduce your state and federal taxes, how to reduce your property taxes in a lot of cases. In January, we're going to talk about human capital, the soft side of the company, stuff that most of us aren't very good at, even if we are responsible for HR. And then we're going to go to a hard topic, and that's facilities. I teased you about that. February, we're going to talk about how can you reduce healthcare costs 25, 30, 40% and not squeeze the balloon to employees, but actually reduce the total cost of healthcare. And then we're going to go to a different topic to hurt your brain, the strategic one of, I sense the owners are getting older. We don't have a great succession plan. I'm 50, they're 65. I bet we're going to get sold to a private equity company in the next 2 or 3 years. What should I do about it? So that's what we're going to talk about. And just as a tease, somebody said, why don't you guys know so much? Why don't you write a book? So we did we helped Paul and other people like Paul write a breakthrough book on healthcare. Kind of a funky title, Breaking Through the Status Quo, but it's how do you break the healthcare paradigm on small companies? And it's real. And that's a good example of one of our topics. We're going to cover that one in February. So with that catch up of technical glitches, Paul,
Thank you, Gary.
any questions I left hanging on the edge that I could address? Anything in the chat room?
I think we're good. I appreciate everybody for attending and for putting up with us as we got our kinks worked out to be able to accomplish this today. We're going to get all those worked out and ironed out very smoothly. You'll see Gary's face on the next event, and we'll send out a follow-up communication from this where you can access a recording as well as the slides and some links so that we can get you to the right places to get some value out of this time that we spent together. So
Paul,
thanks for your
thank you very
attendance.
much. Paul,
thanks.
thank you for that, and thank you for your patience. I figured out the technical issue. It's just I didn't want to switch in the middle of it.
Well,
So I think we're in good shape. We're in good shape for a month from now.
very good. Thanks, Gary,
Thank
and
you.
thanks all for your attendance. And we hope you got some value out of today. And we'll do our best to make sure you can by providing you some resources after. And we'll communicate as well about our upcoming events.